Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, December 16th, and we're about to have a look at the first set of US jobs data since the US government shut down. So investors are cautiously optimistic that a set of weak-looking jobs data from the US could further back the dovish Fed expectations and support risk appetite, but the deteriorating sentiment in technology may complicate things. So we will talk about what the upcoming data from the US means for global investors and what kind of reaction we should expect. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice. So stocks in Europe and the UK benefited from rotation wins yesterday, while the technology-heavy US peers remain under some selling pressure, with Nasdaq 100, for example, leading losses yesterday among major peers. This morning, the futures on both sides of the Atlantic Ocean are looking quite bearish, with Nikkei index, for example, in Japan plunging more than 1.20% today to below its 50-day moving average, pressured by a recent spike in the Japanese long-term yields. Certainly, that looks stable this morning, but also by a stronger Japanese yen ahead of Thursday's Bank of Japan decision, where the Bank of Japan is expected to announce a rate hike. And sorry, I sometimes say rate cut for Japan because most major central banks cut rates this year except the one in Japan. So if I say a rate cut in the context of Japan, well, I mean a rate hike. So a hike this week and probably a few more hikes announced for next year as well. The interesting thing about all that is that this hawkish divergence for the Bank of Japan has not really translated into a stronger Japanese yen since the beginning of this year. On the contrary, the Japanese yen remained under the pressure of mounting but still significantly lower yields in Japan compared to other major economies. And while the sight of the 10-year JGB yield spiking above the 1.70% mark pointed as the level that makes investing outside Japan no longer that interesting for the Japanese investors when taking the FX hedging costs into account created some stress among global risk investors. Some people that I conversed with pointed that the liquidity from the Federal Reserve remains ample enough to support risk appetite, and even more with the Fed's new money injecting program, the RMP, Reserve Management Purchases, that will bring an additional $40 billion of extra cash into the market every month. So to give you a benchmark, that's basically half the amount the Fed spent under the name of QE every month posterior to the subprime crisis. So it's not the same thing in theory, but in terms of liquidity, it's pretty much the same. So in other words, the Fed's latest move on liquidity somehow tempers the stress regarding the Japanese yields and what the big treasury buyers of Japan will decide to do with their money. With or without them, we will have some ample liquidity in the market. That being said, the market mood is not brilliant at the start of this week, and that's certainly because the market is very much focused on the upcoming US jobs, retail sales, and inflation data that we didn't have since the US government shut down. And the jobs and the sales data are due today, and they're expected to confirm weaker job market trends in the US, but a resilient US spending still. While there are a lot of rumors out there regarding the credibility of the US economic data, and not due to the BLS, but due to the shutdown disrupted data collection, and that some believe that the December numbers will actually deliver a more accurate picture of the health of the US labor market. Well, the data that we are going to have today will still give us a full taste of how the markets and investors will be reacting to the data and to these dynamics. For the jobs and sales figures, it is the story of good news is bad news, or bad news is good news. The stronger these data figures, the less need for a Federal Reserve rate cut, and that's perceived as being bearish for stock and bond investors and positive for the US dollar. And if the jobs and sales data are soft, it gives more chance for further Federal Reserve cuts and has a positive impact on bonds and stocks and a bearish effect on the US dollar. But ideally, the data should not be too soft either, too soft to deteriorate the earnings expectations for companies to weigh on sentiment. So it's a very fine balance when it comes comes to the market's reaction to the upcoming data. And there is one more nuance to make things even more complicated, and that's the basic market mood and the basic market narrative of the moment that also makes a difference. And at the moment, sentiment in technology that has been driving markets up since the beginning of 2023 is not great. You would agree with me. Investors no longer see the glass half full these days, half full being great technology, digital revolution, high impact on growth and productivity, but they see it rather half empty being too much investment in AI, too much debt, and uncertain path to revenue. So even a sweet cocktail of figures in terms of Fed expectations today may not necessarily lift the market mood among technology investors, but rather reinforce the rotation trade. And if that's the case, gains in technology-heavy S&P 500 and Nasdaq 100 could remain smaller than for the Dow Jones Industrial Index and for smaller and medium cap indices in the US. Voila, that's my basic expectation. Now let's see what the data will say. In the FX markets, the US dollar remains heavily sold, a bit less this morning, somehow countered by the strength of the Japanese yen, but the outlook for the greenback remains comfortably negative. This being said, there is one interesting chart that shows how the market expectations diverge from the Fed's for next year. In fact, the markets are pricing in 2 rate cuts from the Fed during the course of next year versus just 1 rate cut if you believe in the Fed's latest dot plot. But again, as we insisted last week, the opinion divergence at the heart of the Federal Reserve today is such that the median forecast doesn't really give you an accurate guidance regarding what the Fed will actually do. But the fact that everyone is bearish on the US dollar actually makes me wonder whether it's not time for the US dollar to appreciate a little. But the US dollar weakness sure continues to help gold, silver, and copper gain more field, and the outlook for these metals remain positive with or without a stronger US dollar, as confidence in traditional currencies, including US dollar, euro, sterling, and you name it, wanes with exploding developed market debt levels. Oil, on the other hand, is quite interesting to watch because it keeps diving despite a softer US dollar that should have been positive for oil and last week's tensions around the seizure of a sanctioned Venezuelan vessel. About that subject, well, thinking goes, the news that have to do with sanctioned oil impacts the sanctioned oil market prices in the first place. And unless there is a long-term impact on long-term oil supply in this market, it wouldn't impact WTI and Brent prices. And as per WTI and Brent prices, the market is in such an ample supply situation that geopolitical news have little impact. A potential peace deal with Russia, however, that would bring the Russian oil back to the non-sanctioned market could have a negative impact on oil prices because it would add to the global glut of non-sanctioned oil. So maybe, but just maybe, traders are increasingly pricing a peace scenario in Ukraine, and this is why we are seeing US crude testing the lowest levels of this year. The barrel of WTI is trading near the $56 per barrel level this morning, but I still believe that we will see some solid support into the $55 per barrel level and potential rebound on the back of soft US dollar and these rate cuts. So this is all for this Tuesday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow to comment on the data, but until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.